In June, 7 companies lost $2.3 trillion, not over a year, in a single month. The worst month that group of stocks has ever had. Microsoft dropped 19%. Nvidia, the company everyone thinks is untouchable, fell almost 11%. And here's the strange part. The chip makers, the ones actually selling the shovels, went up. The semiconductor index climbed 90% this year. Money didn't leave the AI trade. It ran from the companies spending on AI straight into the companies selling to them, which is a weird thing for money to do unless you look at where the money was coming from in the first place. Because once you trace it, you find something that looks less like a spending boom and more like a loop. The same dollars going around a circle, getting counted at revenue at every stop. A handful of giant companies quietly passing the same money back and forth, and every pass makes the numbers look bigger. So today, we're going to discuss where this AI money actually comes from, why the people who study bubbles for a living are betting against it right now, and how a thing happening between 4 giant companies ends up sitting inside your retirement account, whether you bought in or not.
Let me be fair first, because this matters. AI demand is real. I'm not going to stand here and tell you the whole thing is fake, because it isn't. Nvidia's chips genuinely sell out. Cloud businesses are genuinely growing. Google's cloud revenue grew 63%. Amazon's grew 28%. People are using these tools every day. The technology works. So this isn't a story about AI being useless. It's a story about how it's being paid for, because there's a gap between two things. On one side, real people typing real questions into real chatbots. On the other side, the amount of money being spent to build the machines behind them. And that second number got very, very big. This year, the biggest tech companies will spend somewhere around $750 billion building AI infrastructure, data centers, chips, power. $750 billion in 1 year. To put that in perspective, Microsoft alone budgeted $190 billion for this. One company, more than most countries spend on anything, and a huge slice of that is just chips. Around $180 billion of it goes to GPUs, the specialized processors that run AI. That's roughly 6 million chips at about $30,000. Now, spending huge money isn't a problem by itself if the money coming back is bigger. So the real question is simple. Where's all that spending coming from? And is it actually coming back?
And this is the part where if you see it, you can't unsee it. Let's start with Nvidia. They make the chips, and right now, everybody needs them. Nvidia agreed to invest up to $100 billion into OpenAI, the company behind ChatGPT. Follow the arrow. What does OpenAI do with money? It buys computing power. It doesn't own giant data centers, so it rents them. It signed a $300 billion deal with Oracle for cloud infrastructure. $300 billion over 5 years. Now follow it again. What does Oracle do to build those data centers? It buys chips. Nvidia chips. See what just happened? Nvidia put money into OpenAI. OpenAI handed it to Oracle. Oracle spent it on Nvidia. The money left Nvidia's front door and came back through the loading dock. And there's a second lap. Microsoft put around $13 billion into OpenAI, but a lot of that wasn't cash. It was credits for Microsoft's own cloud. So OpenAI pays Microsoft using Microsoft's money to rent Microsoft's computers. Every time a dollar goes around this circle, it gets counted. It's investment for Nvidia, it's revenue for Oracle, it's a customer win for Microsoft. The same dollar wearing a different badge at every desk. I'll give you the version I use in my head. Imagine I give my friend $100. He pays it to his landlord for rent. The landlord hires me to fix his roof and pays me the $100 back. On paper, 3 people just did business. 3 transactions, 3 success stories. But there's still only one $100 bill and it's back in my pocket. That's the shape of it. And when demand is rising, nobody cares. The circle spins and everyone looks like a winner. The trouble only shows up when the spinning slows down, because OpenAI, sitting in the middle of all this, is on track to lose around $14 billion this year, nearly triple what it lost last year. The engine at the center of the circle is running at a loss. The circle just hides it for a while. Now, the people running this will tell you the losses are fine, that OpenAI is aiming for $100 billion in revenue by 2029, and once that lands, the whole loop pays for itself, and maybe That's the bull case, and it's not a crazy one. But notice what it depends on. It depends on a company that's losing $14 billion a year today, growing into the single biggest software business on Earth in about 4 years. The circle only works if that bet comes in. Everything spinning around it, the Oracle deal, the Nvidia investment, the data centers, is leaning on that one future number. And even Nvidia's own $100 billion promise has started to wobble. The Wall Street Journal reported the plan had stalled. When the first arrow in the circle hesitates, the whole thing gets a little less circular.
Now, here's where it gets heavier, because that $750 billion in spending, most of it is borrowed. The tech sector is expected to issue roughly $1.5 trillion in new debt over the next 3 years to pay for this build-out. Last year alone, these companies raised $108 billion in debt. So they're borrowing to build. Fine. Companies borrowed to build all the time. The question is what they're building with. They're building with chips, and chips have a problem clocks don't have. They go obsolete. A cutting-edge AI chip is roughly a 3-year asset. In 3 years, there's a faster one, everyone wants that one, and the old one is worth a fraction of what you paid, but the loan you took out to buy it, that runs more like 10 years. Sit with those two numbers. The thing you bought is basically worn out in 3 years. The loan for it follows you for 10. You're still making payments on a chip nobody wants to rent anymore. And that's assuming the spending actually pays off. So let's check. MIT ran a study on companies rolling out generative AI. Real pilots, real budgets. $30 to $40 billion of enterprise money went in. 95% of those projects produced no measurable return. None. Only 1 in 20 actually made money. Line it all up? Around $750 billion a year, mostly borrowed, spent on hardware that's stale in 3 years, feeding projects that pay off 5% of the time. That's not a rocket ship. That's a bet with a clock on it. If this pattern feels familiar, it should. We ran almost exactly this experiment 25 years ago. Back in the late 90s, everyone knew the internet was the future. And they were right, it was. So telecom companies did the logical thing. They borrowed enormous amounts of money and laid fiber optic cable across the country. Over $500 billion of it. Most of it financed with debt. Sound familiar yet? They laid it fast, ahead of demand, because everyone believed internet traffic would double every few months forever. Build the roads now, the traffic will come. The traffic did not come, at least not on schedule. By 2001, something like 95% of all that fiber was sitting dark. Dark fiber. That's the actual industry term for cable that's in the ground but never switched on. They'd built for 100 and about 5 showed up. The demand was real. It just arrived years later than the debt payments did. And in between, the bill came due. Telecom stocks lost more than $2 trillion between 2000 and 2002. WorldCom went bankrupt, the biggest bankruptcy in US history at the time. Global Crossing, gone. Company after company that had borrowed to build the future got buried by the timing of it. Now hold that next to today, a build-out measured in the hundreds of billions, financed with debt, built ahead of demand, on the belief that usage will explode to justify it. And the thing they're building, the chips, might turn out to be the new dark fiber, racks of GPUs bought on credit that go obsolete before the demand shows up to pay for them. The internet still won in the end. The people who financed the first lap of it mostly didn't. That's the part the winner's story leaves out. Being right about the technology and being right about the timing are two completely different bets, and the debt only cares about the second one.
So who noticed? The people who get paid to notice. You might know Michael Burry. He's the investor who called the 2008 housing crash. The guy Christian Bale played in The Big Short. He spent this year building one of the loudest bets against AI on the market. He holds put options, that's a bet a price will fall, on 1 million shares of Nvidia. He's betting against the semiconductor index out to 2027. He's betting against Palantir, against the NASDAQ, against Oracle.
The idea that chips and ontology is what you want to short is bat crazy.
Roughly 1/10 of his entire portfolio is now positioned for this to go down. He thinks these stocks could fall around 30%. His words for the whole chip spending frenzy? The beginning of the end. And look, one guy being bearish doesn't prove anything. Burry has been early before, and early can look wrong for a long time. But he's not making a vibes call here. He's naming the exact same pressure points we just walked through. The chip makers, the circular deals, the debt. He's putting money on the plumbing, not the technology. And the place that crack is showing first is Oracle. Remember, Oracle took the $300 billion deal to build data centers for OpenAI. To do it, Oracle borrowed heavily. Its total debt jumped 40% in a year to $124 billion. Then the market started pricing in the risk that Oracle can't pay it back. There's a thing called a credit default swap. Basically an insurance price on a company's debt. When it climbs, it means people think default is getting more likely. Oracle's tripled. It went from around 40 to over 150. That's the worst credit deterioration at a major tech company since 2008. And the customer this whole bet was built on? OpenAI is now walking away from expanding its biggest project with Oracle because it wants newer chips somewhere else. So look at the circle again, but running in reverse. The customer pulls back. The debt stays. The insurance price on that debt spikes. This is what it looks like when a loop that spun beautifully on the way up starts to unwind. Not a crash in one afternoon, a slow tightening, one deal at a time. And that's the quiet danger of a circle. On the way up, every connection makes everyone stronger. Nvidia's investment lifts OpenAI. OpenAI's spending lifts Oracle. Oracle's orders lift Nvidia. But those same connections run both directions. If one node stumbles, the wiring that carried all that strength up now carries the weakness back around. The thing that made it look unstoppable is the exact thing that makes it fragile.
Here's where you come in, and you might not like it. You probably don't own Oracle. You've maybe never bought a single Nvidia share on purpose. You might think none of this touches you. It does, through the most boring product in finance, the index fund. Those 7 companies that lost $2.3 trillion in June, they're not just any stocks. Together, they make up about a third of the entire S&P 500. 7 companies, a third of the index that half the country's retirement money sits in. So if you have a target date fund in your 401k, or an S&P 500 index fund, or a total market fund, you already own all of them. Not because you studied AI and decided to bet on it, because you bought the market. And the market quietly became one big AI trade while you weren't looking. That's the thing about passive investing. You didn't choose Nvidia. The index chose it for you. By weight, when those 7 names are a third of the index and they drop $2.3 trillion in a month, a third of your index fund is having that month too. You didn't buy a ticket to this ride. You got put on it automatically by owning the most recommended thing in personal finance. And I want to be careful here. This is not me telling you to sell everything and hide. Index investing is still one of the most reliable ways ordinary people build wealth. That hasn't changed. What's changed is what's inside the index. It's more concentrated and more tied to one story than it's been in a very long time. Knowing that isn't a reason to panic. It's just a reason to actually know what you own. And if you want to do something with that, it doesn't have to be dramatic. Some people look at this and move a slice of their money into an equal weight version of the same index, where every company counts the same, instead of 7 of them counting for a third. Some people just check what their target date fund actually holds, which most of us have never once done. And plenty of people look at it all and decide to keep buying exactly what they were buying, because they've got 20 years and they'll ride the dip. All of those are reasonable. The unreasonable one is not knowing which situation you're in.
So let me bring it back around. The AI boom is real. The chips are real, the demand is real, the technology is genuinely useful. None of that is the argument. The argument is about the plumbing underneath it. Money moving in a circle and getting counted 3 times. A build-out paid for with debt that outlives the hardware it bought. A pile of projects that mostly don't pay off yet. And a handful of companies so large that when they wobble, they pull your retirement account along for the ride. Maybe it holds. Maybe demand catches up to the spending, and the circle keeps spinning and this whole video ages badly. That's genuinely possible. But maybe it doesn't. And the people who study this for a living are right now putting real money on it doesn't. You don't have to pick a side today. You just have to know the ride you're on, because the one thing worse than being in a risky trade is being in one and not knowing it, and finding out only after the month everyone else already saw coming. So here's what I actually want to know. Did you have any idea your index fund was this deep into AI? And now that you do, does it change anything? Out of every arrow we traced today, Subscribing is the one that points back in your favor. Do that, and I'll make sure the next thing worth understanding finds its way to you before the month everyone else finds out. I'll see you in the next one.